battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 44 years, the Stenger family has made it our mission to deliver both clarity and confidence to help secure your financial future. You've been wondering why you have to listen to the show every week. You've been wondering why I keep saying the same thing week in and week out, which is to stay on your plan, don't panic. And the reason why is because the market is now back up to 5,700 points. We'll get into it in just one second. But don't forget, if you are watching on YouTube, Apple, or Spotify, please hit subscribe, share it with your friends and family. We would so appreciate it if you could get the show out to them, and especially the subscribe button. That is the most important as we get the show out to more and more people, get them the clarity and confidence, the good news, the reasons why they also have to stay on their plan. Wow, episode 184. Hard to believe Mr. Market was wrong again. We talked about Mr. Market the past two episodes now. You remember Warren Buffett's mentor, Ben Graham, who wrote the book on fundamental patient investing. And what did he do? He described Mr. Market, who calls out to you and says, hey, I think the house that you paid $400,000 for is only worth $300,000. And he comes back the next day and he says $350,000. And then another day he says $500,000. Another day he says $100,000. And it's just a bunch of noise and racket. And you say, Mr. Market, I'm not really ready to sell you my house. So I don't care what price you say. I don't care if you say 200, 2 million. I'm not ready to sell. I'm going to sell to you when it's time to sell, not just because you're yelling out a random price. That is the key of being a good investor. And so when you buy a home, many of our clients have bought and sold a home here in the past couple of years. You might have noticed on Zillow, right after you sold that house, maybe it went down 10,000, maybe it went up 10,000 on this estimate. Who knows if those are really that accurate or not. But just because the Zillow estimate says it's down 10,000 or 20,000 right after you bought it, are you going to go panic and sell your house the second after you just bought it? Of course not. No, that's ridiculous. You would never do that with a real asset like that. Well, stocks are real assets too. You just can't see them and touch them, taste them, and smell them when you have your Schwab portfolio up. But stocks are real. And stocks are a claim on real assets. So when you see Home Depot, for example, in your portfolio, you literally own a piece of Home Depot. So you could go to a Home Depot store and walk around, and you're technically walking around in your store. Now, not really in the sense that you own a whole store. You own probably a very small piece of it, depending on your portfolio. But the idea is the same. You own common stock in Home Depot, in Costco, in Procter & Gamble, in Walmart, in AT&T, in all these American companies. And so you literally have a claim against that company's balance sheet, against its real assets, against its intellectual property, against its cash. And so you have to understand and you have to think about stocks the exact same way you would think about your home. It's an asset. And just because Mr. Market comes in and says, oh, this is, now's the time to sell. I'm going to give you 400 grand for a portfolio that you paid 500 grand for. It's your job to decide if you want to listen or not. Now, where do fiduciary financial advisors come in like us? How do we help you with this? Well, we help you avoid the biggest trap on earth, which is to believe from the media that this time it's different. Remember, the market corrects all the time. We have a big correction every 10 years or so. Sometimes it's a recession. Sometimes it's just a major shock to the system. You'll remember COVID. Market was down 30% in 2 weeks. You remember 08 and 09. That was a recession. Market was down 60% at the worst point of 08 and 09. Literally, if you had a $1 million portfolio at the start of 2007, by the bottom of 08/09, going into the early part of 09, there was a point in that where the $1 million portfolio was literally only worth $400,000. Now, intrinsically, was the value of that portfolio really only worth 400 grand? Or was it just Mr. Market yelling out 400,000? Well, it was just Mr. Market yelling out 400,000. And how do I know that? Because within 3-4 years, the market had recovered all of its losses. Remember, you were still getting dividends along the way down. You were reinvesting those dividends. And that $1 million portfolio broke even in about 4 years. That's the most severe recession that we've had in a long time. And I do not believe we're going to have something even close to that. It may not ever happen again, but it might. There's a chance it could happen, but I think it's very low. What we get nowadays in this new environment we're in, where there's a little bit more guardrails on the financial system, is these larger 20%, maybe a 25% decline if the market thinks we're going to head towards recession. Now, the past couple episodes of my show we've done of Bullish, we just put out a new episode of Bullish, myself and Sam Hardy, that you should go watch. We put recession in the name of the show. Not that we think we're going to go out into an all-out abyss and go into a big recession. In fact, I think the opposite. I think the economy is going to be pretty resilient here. Although to say, once we get some impact from the initial part of tariffs, you could see a small decline here in real GDP. It's absolutely possible. It's not just because of tariffs, though. When you get to second or third quarter, it's actually going to be because the Fed is still shrinking its balance sheet. So we are going to have these 20-25% declines in the stock market about every 3 or 4 years because it lines up exactly with the Fed's hiking cycle. And so when the Fed gets a little bit tighter with interest rates, when they start to tighten monetary supply is what it's called, you're going to see these bigger corrections. Why? Because in the past, they have triggered recessions. Now, most of the recessions we have are nowhere close to 08 and 09. Most of them aren't even close to 1987. Most of the recessions that we have today are usually pretty mild. And you have to see a consecutive 2 quarters of real GDP go down, 2 quarters of real GDP, meaning inflation adjusted, in a row, and then also coupled, according to some economists, with a massive spike in unemployment. You just haven't seen that spike in unemployment. The last time we had unemployment go way up was COVID. We hit 12, 13%. That was short-lived. It was temporary. We came back to normal 2021, 2022, 23, 24 now, and 25. We've been basically at record tight labor markets. It's impossible to find workers still, and that's for most parts of the market. So when you have all these unfilled jobs, when you have record low unemployment around 4%, even a small decline in real GDP is not going to impact people the way that you might think. The market already went down that 20%. So when I say we're going to have these Fed hiking cycles in the market every couple of years, every 3 or 4 years may go down 20, 25%, you've got to remember it already happened. I don't think we're going to retest that 5,000, 4,900 point low that we had. We may bounce around a little bit at 5,400, 5,500, 56, 57, where we're at today. But that major part of the correction has already happened. If you are looking for a better time to buy, this you may not get it. This is probably it. So if you've been waiting and sitting on cash and you've been trying to get into the market, this is probably still one of your best buying opportunities. If you could have figured out when to time it perfectly and get in at 5,000, you get an A+++, okay? And that was a phenomenal time. We told you on the show, buy. This is it, 5,200, 5,300. But anywhere in here, this is probably one of your better buying opportunities, even at 5,700 today. I think the fair value on the S&P will approach the 7,000 point level, even if it takes a year. Maybe it takes 18 months. It's all going to be Fed dependent at this point of where we end up with the tightening cycle. And so once the Fed gets past that, you're going to see the market take off and hit record brand new all-time highs. Remember how the market works. It's always going to overshoot on the upside. It's always going to overshoot on the downside. So 4,900 was way too big of a sell-off. It was way too much, way too fast. But at the same time, if you hit 7,000 and it happens faster than I think it's going to happen, maybe it happens in 12 months, that could be a little bit too much too quickly. So you see these Mr. Market swings where, again, fair value on the S&P might be 62, 6,300 points. Some people say it's a little bit lower. Some people say a little bit higher. Mr. Market is going to tell you one day it's 7,000, one day it's 5,000, but you are not going to panic. You're not going to jump off your plan because of Mr. Market. So remember, all of this is done on a goals-based financial plan. Everything that you want to do in your portfolio is all based on what am I trying to accomplish. Now, I want to address something that came up with a couple of our clients the past few weeks with the correction happening, where people said, Nick, why aren't you guys doing anything? How come you're not trading the portfolio? I see these people on CNBC and they're talking about a stock they like and a stock they hate, and they're buying and selling and getting in and getting out. And I say, if you're doing that consistently in the portfolio and you were on a goals-based plan, meaning you had a plan and then you invested according to that plan. If the plan was so good, then why do you have to constantly tweak and adjust it? That's why you don't see tons and tons of excessive activity from Stenger Family Office. We went into the January of this year, the end of last year, and we were relatively very happy with where we had the portfolio. Now, we knew a correction was possible. I told you, corrections coming at some point, but the portfolio we had clients in and still do was we felt very resilient to deal with some of these ups and downs. And it has been. It's actually done very, very well through all these different cycles. And we have value stocks in the portfolio, we have dividend stocks, we have growth stocks. But the way we have the portfolio balanced, we felt, and the types of companies we have in the portfolio, we feel are good companies for the long run. And so all this buying and selling and trading and getting in and getting out and looking busy, I call it, really has not helped people in the long run. They may outperform in a quarter, they may outperform in a month, but remember Warren Buffett, remember Berkshire Hathaway. Warren Buffett is going to retire here, it looks like, pretty soon at the end of 2025 and be replaced by Greg Abel, who's also supposed to be excellent. And what has Warren done for his whole career? He's bought and held great companies. And so that's what you want to do too in your portfolio. If you own a company, and I'm not giving individual stock advice, but if you own a company like Sherwin-Williams, the paint stores, you've bought and held that company over 40 years or 50 years, and you've ridden it up and down some pretty scary times. But if you had just held it for the past 40 years, you'd be up literally over 40,000%. 40,000%, if you can believe it. And how many different names do we have in the portfolio that are just like that? From ExxonMobil to Johnson & Johnson to McDonald's to Walmart to all these strong American companies. And it's not to say that they're not going to go down once in a while. Of course they're going to go down. But we feel that they have good enough balance sheets, they've got good enough business models, good enough operating leverage is what it's called, where they're going to see the other side of the recession, of the correction, anything that the market throws at us. Now, not every company in the portfolio will make it. So if you own 50 or 60 companies, you may have 2 or 3 or 4 or 5 that just don't make it. But if you're diversified across a basket of securities, some are going to be up, some are going to be down, and over time, more of them are going to make it than not make it if you're buying the biggest and best. Now, you can't say that for every industry. You can't say that for every sector. You can't say that for small caps, for example, or mid caps. But when you look at the biggest and best companies, they're run by the best and brightest management teams. Over the long run, they've done exceptionally well in bad times and good times. And the best thing that you could have possibly have done over that time frame is just hold on. And so, again, it's not the answer that we really think is fancy or that we like to hear, and it doesn't sound all that interesting. You know, we could get on this show every week and tell you, oh, we sold this and bought that and traded this and shorted and bought and sold, and we could do that. But it's not really, in my opinion, if you look at history, it's not really going to add value to clients. What's added value to the portfolio and added value for our clients is buying and holding over the good times and the bad times. So don't take a lack of activity at Stenger Family Office as, oh, Nick's not looking at it and Bond's not looking at it. No, it's the opposite. We meet literally every single week with our investment committee, constantly looking for opportunities, looking to make sure we have things balanced correctly for clients. But right now, the best move is to hold on and do nothing. And so if you look at the next 6 months or so, you may see us do a rebalance. We'll certainly do our rebalance here in November. We've got Investor Day coming up that you should absolutely come up to. It's in October this year in Chicago, October 16th and 17th at Gibson's Steakhouse in Oak Brook, just right outside the city. Don't miss that thing. Don't miss that event. It's going to be sold out so quickly. We're going to send out the invite to you very soon, but make sure you register. That's how we talk. That's where we talk about the rebalance and educate our clients on what's going on in the portfolio. But the biggest thing, and the reason you would change your investment strategy, this was another question I got a few weeks ago from a client. Nick, when does the plan change? When do you adjust? The plan changes if you need money from the portfolio. If you change your goals, now we want to go back to the drawing board and possibly change your investment plan according to your goals. Let the goals be the driver of the investment plan, not your risk, not what CNBC says one day or what the Mr. Market's doing. Let it be your goals. That's the key to a successful retirement and a successful financial plan. I'll give you an example of that. We had one of our clients who was going to have to go into a nursing home, and it was going to cost the family a lot more money than him living at his house. And it went from the fact that we were going to have a couple $100,000 in safe money in the plan to a couple million. And that's when we sold equities. We sold them back in January when the market was at all-time highs. Again, that wasn't a move to try and time the market. That's not because we thought the market was going to go down. It's because there had been a change in the client's goals. That's when we want to change the plan. So stick on the plan, stay on course, don't jump ship, don't make moves based off of risk, make them based on goals. Thanks for being on for this episode 184. We'll see you next time for episode 185. Don't forget to like, share, and subscribe. Thank you so much for being here.